Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Patrick Geddes, who's the co-founder of Aperio Group. Patrick, welcome to the program.
Thanks very much, Mike.
Hey, so I always like to ask the question, what got you into the industry that you're in? And since you're an entrepreneur, what has your entrepreneurial journey been like to this point in your career?
So I started in the investment industry in the early 90s. I was Morningstar's first research director and then became their CFO. And then a few years after that, I was casting about for a job in the investment industry and realized that I didn't want to have to work at a place where I'd have to lie for a living, and unfortunately, in the investment industry,
that's a broad brush,
and it was a very rigid, picky definition of lie, meaning mislead. And I just realized that doesn't leave much because most of the industry is trying to do the right thing, but is not terribly honest with its with our clients in terms of what we can and can't do. So that led to starting Aperio Group, and we ended up growing to about $42 billion in assets under management at the end of 2020 when we were sold.
Excellent. So let's kind of not name names, but give us an example of what would that misleading of or blurring the lines of what is in the investment industry. If you are someone going to an investment advisor, what is an example of what they should watch out for?
So the biggest problem with the investment industry is when we try and pretend we are wizards with a crystal ball. And most investors want two things from the investment industry. One, I want you to time the stock market. I want you to tell me when the stock market's going to be up or down. What are your forecasts? The second one is I want you to pay, like, who wants to just get average? I want you to pick the stocks that are going to outperform the market. Who wouldn't want to outperform the market? And those two are real danger signs because the data, the evidence are so overwhelmingly against anybody or investment professionals being able to do that on average. It doesn't mean that there aren't people who can, but on average, the odds are heavily stacked against you. So the problem is, as consumers, as investors, we crave that certainty psychologically, and the investment industry is frequently pandering to that, even though it's incredibly clear we can't provide that. That doesn't mean we can't provide a lot of guidance, value, but not on those two big issues.
Yeah, you can provide guidance, but you can't say, here's where the market will be, and here we need to enter here, we need to exit here, we need to go to cash here. And I mean, I just remember, this is stuck in my mind for decades, but at some point, one of the leaders of Greece had some personal issue, and that caused our markets to go into a tizzy. It's like, that's not in performance based on earnings reports. That's like some external thing. So how in the world could any financial investment firm be relied on to give you advice like that? Because you never know what those external factors are going to be. Now, you can give great advice like, well, hey, we should stay in this sector because we feel it's going to do well. But I love on your website, at the very top, it says investing to-do list, buy an index fund, go garden, wait 20 years, there you go. And in reality, that's somewhat of a true statement because you do not want to have the mentality of, Patrick, I saw what the markets did today, and so now what do we need to do? No.
Exactly.
Don't go into what happened yesterday, what's going on today. You need to have that long-term mentality, but you also want to feel at least like you are following what's going on, and waiting 20 years to, the annual review. Yeah, that's good, but you should have the ability to have some back and forth dialogue. When is it too much?
Pretty much never. Again, the data show that we crave psychologically what is called the illusion of control. It's something in an academic field called behavioral finance, which is like pretending we control things that are in fact random. So the problem is investors, exactly as you described, investors love that kind of, we're in the middle of things, we're on top of it. The reality is that there is no control, and it's basically an illusion sold by the investment industry that even if you are indexing, discussing like which sector is going to do well, that is counterproductive. And the data are so powerfully against it. The problem is, it's like saying, if you've got a weight problem, just eat less. Well, that's not very helpful because our minds, our brains are wired through evolution.
There's got to be more.
For certain craving. And we have the exact same problem as investors in that we crave, the equivalent of unhealthy sugary foods because they taste really good, but they're actually not good for our long-term financial health.
Right. So what's another myth in the investment world that you cover in your book? And I know your book, Transparent Investing, How to Play the Stock Market Without Getting Played. So talk about one of the myths you cover.
It's also about, in addition to that psychology, the book's about how to interact with the investment industry. So one of the myths is this is so complicated, I couldn't possibly do this myself. The problem is there are a lot of investors who do need to hire someone. And one of the things in the book, in fact, you can even get a free download of the chapter on should I hire someone or do it myself? That's a tough call. But the problem is most investors make that decision based on the assumption that it's so complicated. I need to spend a lot of time. I need an advanced degree in finance. And the answer is no, no, and no. How much time should people spend on their investments? I get asked that constantly. This is not a flippant comment. I recommend about an hour and a half every 3 years. And people just look at me, no, come on. No, that's maybe for the little people. I'm a player. It's all about behavior. And so one of the myths is you need us to you need us to guide you through these tricky waters. But the actual solution can be so simple that it means you might not need an advisor, but there's still lots of things where wealth advisors can actually add a lot of value. Talking people off the ledge. People are notorious for selling in a market downturn. If an advisor helps hold your hand, that's more like a good coach telling you not to do something that's going to harm yourself. There's a lot of complicated financial planning, tax issues, where an advisor can be really helpful. But the basic premise, I want them to beat the market or time the market, that's the part that's bogus. The problem is investment advisors don't like telling people we can't do that, because then you do get the inevitable question, so why exactly do I need you on an ongoing basis?
Yeah, right. If I can do it. Okay, so here's, you brought up the thing about weight and losing weight, and let's use that analogy with the concept of a cheat day. So if someone wanted to lose weight, you're going to stick to a diet and have a cheat day once every, three weeks.
Yep.
So let's take that, and I'll ask you this question.
Sure.
Maybe the general approach should be let your wealth manager do what they do. Don't get all uptight about the market because it went up yesterday, down the next day. So let's let it ride, because we talked together at our meeting last month, and we've set this in place. Let's give it time. Let's trust the process. But since you have this itch to kind of be doing stuff, and for some investors, this is what could be. If you've got an affluent investor, hey, take 20 grand and let's take that and park it off to the side and put that in an account that you can go ahead and do whatever you want. And if you feel like you're going to watch this and move that, do that. And then, but let's keep your wealth, staying the course. Is that something where for some investors, it would make them feel like, Patrick, thank you so much, because I just want to feel like I'm doing something. And you know what I'm saying? I don't hear that a lot when you talk about wealth investors going, here's part of your retirement plan, have a little sandbox.
Right. It's like, it's your mad money, your play money. And I've often heard sort of, as long as it's like, 10% of your portfolio, that's fine. I even heard the argument that I actually find interesting. I'm not sure I completely agree with it, but I don't dispute it. That says for many investors, depending on their psychology, they're actually going to do better with that cheat day equivalent of, every 3 weeks you get to eat chocolate cake. Because in my book, I talk about investing as a food analogy of it's broccoli versus chocolate cake. Okay. And the industry is selling a lot of chocolate cake that is scrumptious. Who would pick broccoli? I like baking. I'm a chocolate cake baker. I make a really wicked devil's food cake, but it's still not healthy. But what you're saying is, couldn't you avoid doing yourself real harm as long as it's a small sort of play money, and then you get to go crazy? And I've had it argued, people will stick to the diet in effect of smart long-term indexing better if they get to play a little bit in the sandbox. And I'm not such a purist that I'd say no, never do that, as long as you're going in with open eyes. The danger is, like, what if in your play money, like for 3 years in a row, you beat the market? Then you start thinking, I got the Midas touch. That's the kiss of death. That's
I agree with that. And then what you would need to have the conversation, if you were the wealth manager and the client comes to you and goes, check out my play money. Well, the mentality there is, you knew it was play money, and you maybe took a little bit more risk than you could have. So you probably would not have, if you knew this was your life savings that you need to live on for retirement, you probably would have treated it a little bit differently. So I think there's layers of psychology there. So let's get into one of the points that you brought up with how to hire a wealth manager. What are some of the considerations someone should think about? Because you certainly don't go Google best wealth manager, find the one on top and go, you're hired. You need to be interviewing them as much as they're interviewing you.
Yeah. So start off with something that is actually hard for many investors, which is defining what you want out of this relationship. And I start with the recommendation of, if you're looking for someone to beat the market or pick the active management, the stocks that are going to do better than indexing, you're already likely to lose money by going to a wealth manager, if that's your reason. So start with, what's your situation? What are your needs? If you need help with financial planning, if you've got like one-off situations that, things pop up all the time. We have complicated financial lives, especially the wealthy or the ultra high net worth. So figure out what you want out of it. And then typically there's a criterion of, well, how much time and energy do you have to put into managing your own portfolio? That does matter, but most people assume a much, much higher level of time commitment than is actually required. So it's really about sorting through what I call the useful services that a wealth manager can provide versus the I call them suspect. Let's actually call them bogus. The ones we've been talking about, the outperforming.
Yeah, that's a really good point. And you mentioned about the chocolate cake, and I've heard it, sell the steak, not the sizzle, because the chocolate cake and the icing, that's really great. But in reality, you got to make sure you've got good flour and, the cake foundation. So what are some of the foundational things that people should make sure they are getting taken care of when choosing a wealth manager, and not get swayed with, the
sexy story,
the distraction? Yeah.
So, the most important thing any investor should focus on is actually one of the more boring. It's fees.
Yeah.
Because there's a very direct relationship that the less money you pay an advisor, the more money you're going to keep. And so focusing that strongly on fees feels kind of counterintuitive. Like, well, I'm just getting low end advice. I want the best of the best. The problem is the best of the best are not predictably worth paying for that effort to outperform. So view it the way you would any other consumer decision, and convert it to dollars. Like, if you have a big portfolio, I'm paying somebody whatever, $30,000, $50,000 a year in fees. Is that a worthwhile outlay? One of the analogies I use in the book is, I don't change the oil in my car.
Yeah.
But if it cost me $20,000, I would figure out how to crawl into there, unscrew that little bolt, get the drip pan out. And so there's a kind of disconnect between the amount of money you pay many services. Like when you pay a lawyer or your accountant, it's very clear and direct. With a wealth advisor, you pay them indirectly. They almost always are taking a little bit out of your portfolio, and you kind of don't see it, and you don't realize how much money you're paying. So that would be one of the big points of focus when interviewing someone is, I want to hear all the fees, yours and all the underlying. That's the biggest driver. It's not the most exciting, but it is the most important.
Yeah, because as an example, you could be paying whatever, let's say 1% for managing your portfolio, and they say, "Oh, I only get paid when your portfolio goes up," and that's a true statement. But then that's one fee. But then there's another fee of maybe we place some percentage of money in this mutual fund. Well, maybe there's some loads and some fees there. So all of a sudden now your gains of X% this quarter are a lot skinnier because you start shaving off these fees and these fees and these fees. And that's a huge thing to keep in mind. And that's, I always, you sound like an analogy person. So I use the bucket analogy with the holes in it. It's like you might think, you would need to pour more water in the bucket, more water in your portfolio. But in reality, you need to be doing both, which is plugging up as many holes as possible, which is expenses, fees, and taxes. And you can't eliminate any of them, but you can mitigate many of them. So let's say that they, answer back and the fees are very fair and nominal. What's the next consideration that you need to be keeping in mind
for hiring an advisor?
Yes.
So it's really about their philosophy, and the more they're just putting together a simple portfolio of index funds for the stock side, the more trustworthy they are. So it's all about boring research-driven recommendations rather than the stuff that's really exciting. And you do need to have, good rapport with an advisor, but focusing on what you want out of the relationship that's realistic, as opposed to, I'd love to, find a private equity manager that's going to buy all those unicorns for me and make a killing. Very appealing story. It's almost as though we need to wean ourselves from our natural craving for that exciting story, because investing is about good behavior much more than it is about analysis. So you're trying to suss out in an interview what assumptions the advisor is making. The problem is that a lot of active management gets sold because it avoids that problem of, well, then I won't be perceived as adding any value. And so advisors don't want to go that way. There's another problem in the industry is that most fees and compensation get earned as a percentage of assets. And what would be a much better model for consumers, although it's hard to find, is more of a kind of hourly retainer model, like the way you hire an attorney, or, as I said, a coach. You really should think of your wealth advisor as your financial coach. And there's a lot of expertise there, but they can't promise you're going to run the 100-yard dash, 3 seconds, then your body will actually be able to do it.
Yeah. Yeah, I mean, there's so many elements that go into being prepared for retirement. So I need to have someone guide me, coach me, and then all of a sudden it seems so easy on the outset, like, oh, well, shoot, I could have done that. But in reality, could you? Because these advisors are spending their career learning all the intricacies of if this, then that, if the market does this, or if this sector does that, or if, the taxes or the government or the administration makes these moves that's going to impact on people's retirement, which is that I think that there's, yes, you could learn how to do it on your own, but are you really going to be so dialed in unless you're fully retired and you just geek out on learning all of this stuff? That's probably the 0.001% of the population out there. So I think that most of the time people need to have that trusted advisor that they know is going to treat them right. They know have got low fees. They know are aligned with them philosophically, going to put them in the right, types of sectors and funds and not be too aggressive. And then maybe if you wanted to have that kind of a play money or whatever, or maybe if they allow you to brainstorm with them once a month or once a quarter and go, hey, what do you think about? But I think that's where people make the mistake, is they just think it's so easy and why should I pay you X? But there's a lot that goes in behind the scenes that you just don't know about.
But it's very important to distinguish between expertise on things like different retirement plans, impact of taxes, and a lot of the allure is staying on top of sectors, a lot of awareness, that is all bogus. The industry has a track record of not being able to turn that into more money for you.
Wow.
And so it's this incredibly frightening reality of, well, who is in control of that? Nobody. It's random. And that's a very sort of disturbing existential concept. What do you mean no one's in charge? So the expertise is real. The staying on top of things is bogus. Unless you describe it as staying on top of your psychological state. That is real. And an advisor can help you on that. But all that training of catching the nuance on what sectors, it's just not supported by the data. So it'd be great. What that description they give, that sales pitch, is incredibly appealing. It just doesn't fit the reality of how we've actually performed as a profession.
So I love that you wrote a book, and that's awesome. And then I also love that you have a companion online course. So talk a little bit about how the course supports the learning in the book.
So the course was just a way to try and address situations where someone might say, you know, I'm not going to spend the time to read a book that's very sort of analytical sounding. Don't you have something that's a little easier to access? And so it's an online interactive course, lots of interaction, unlike a book, but the exact same themes and arguments. And then similarly, there are about 11 videos on my website that are just ways to try and use a little humor, some animation. There are a couple of musical versions on there just to get people to sort of break the normal assumptions. There's one that I think works really well for me about the famous scene in the movie The Wizard of Oz, where Dorothy, after the Oz has been outed by Toto, who pulls the curtain back, famous line, pay no attention to the man behind the curtain. Everybody uses that. So Dorothy marches over to him and says, "You're a very bad man." And he says, "No, I'm not a bad man. I'm a very good man. I'm just a bad wizard."
Yeah.
And that is an exact description of the investment industry, where he can be really helpful. He turns around and gives counseling and sort of moral support to the Cowardly Lion, the Scarecrow, and the Tin Man. But he's only useful once he stops pretending he's the great and powerful Oz. Yeah. That analogy, I think, describes exactly how people need to look at investing.
I love it. Well, Patrick, if someone is interested in learning more about your service, your book, and your companion course, what's the best way they can reach out and connect with you?
That would be my website, patrickgeddes.co.
And I will have that direct link in the show notes, as well as the link to your book. And I thank you for your time today. It was really great hearing some thoughts and views of how you serve your clients and in the industry. So thank you for coming on.
Great. Thank you, sir. It's been fun.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.